Okay, guys, so I am actually just going to kick off now. So welcome to the MortgageLine First Time Buyer webinar. Yeah, so my name is Stephen Hamilton. I'm the Managing Director of MortgageLine, and today I am joined by my colleagues Joanna and Kevin. Joanna is our Operations Manager here at MortgageLine, and she's going to be helping me out with the Q&A at the end. And Kevin is a Qualified Financial Advisor here with MortgageLine, and he will be helping me out with answering the questions in the Q&A session. So I'm just going to kick off, guys, and I'll let you know what we're going to be covering off today. So today I'm going to be covering off getting mortgage ready and what that entails. And then I will move on to talk about how much you can borrow and the different things the banks will look at when deciding how much you can borrow. Then I will look at the various schemes available to first-time home buyers, and specifically we'll be looking at the Help to Buy scheme and the First Home Equity Scheme, and we'll talk you through the ins and outs of those. And then we will be moving on to talk about mortgage advice and your options. So when it comes to the time to make a mortgage application, what are your options and how you go about doing that? And then at the end, we'll be covering off questions and answers. And again, my colleagues Kevin and Joanna will be helping me out with that. So first of all, getting mortgage ready. So what does that entail? So the good news is, no matter where you are in your mortgage journey, it is possible to plan to be mortgage ready within 6 months. So what do I mean by that? So when you're making a mortgage application, a bank will look at what you've been doing over the last 6 months. So a main document that they'll look for when you're applying for a mortgage is they will want to see your last 6 months bank accounts. And in those bank accounts, they'll be looking at a number of different things to make sure that you're financially able to afford a mortgage. So they'll look at the history of your rent and savings over the last 6 months. Are you paying those on time? They'll also look at what they call your repayment capacity. So what is repayment capacity? Repayment capacity is something that's very important when it comes to getting a mortgage. Banks will want you to show that you can afford roughly €600 per month for every 100,000 you want to borrow. So if you're looking for a mortgage of 300,000, then you would need to show repayment capacity of €1,800 per month in the 6 months before you apply. So that means from your rent and savings, you need to be showing €1,800 per month if you were looking for a mortgage of 300,000 or more. Things to look out for on your bank accounts and to make sure you avoid are irregular bank transactions. So try and avoid any missed or late repayments on your bank accounts. If you have an overdraft, make sure you're staying within your overdraft limit. And if you have a credit card, just make sure you're paying that on time and not going over your limit as well. One big no-no in your bank accounts in the 6 months before you apply is online gambling. So make sure you're not making multiple online gambling transactions. That looks very bad on your bank accounts in the 6 months before you apply for a mortgage. So in general, just keep your bank accounts in good order and make sure you're managing your finances well in the 6 months before you apply, because it is really that 6 month snapshot that the mortgage lender is looking at when you apply for a mortgage. So make sure your bank accounts are as clean as possible in the 6 months before you apply. You want to make things as easy as possible for yourself, and things like online gambling, missed or late transactions, they just make it harder to get mortgage approval, and it just makes things harder for you and harder for a mortgage underwriter to approve your mortgage when you need it. So keep things as clean as possible, guys, in the 6 months before you apply. So moving on to how much you can borrow. So in 2015, the Central Bank of Ireland introduced the mortgage lending restrictions that all mortgage lenders must adhere to. So what does that mean? Well, they introduced lending restrictions in terms of multiples of your income. So as a first-time buyer, you can borrow 4 times your income. Home movers or second-time buyers can borrow up to a maximum of 3.5 times their income. So the max loan amount you can qualify for is an LTV of 90% or 4 times your income as a first-time buyer. So that all sounds quite simple, 4 times your income or 90% of the property purchase price. So what's the catch, you may be asking? Well, yeah, it's not as simple as just a multiple of your income or a percentage of the loan to value. There are a number of different things that the banks will also take into account when determining what you can borrow. So they will look at these other things as well. So when deciding what you can borrow, the 4 times your income is not just your basic salary. They will also take into account things like variable pay. What is variable pay? Sorry, first of all, variable pay is things like overtime, bonus, commission, extra payments that you get paid on top of your normal salary. So with variable pay, if there's a consistent history of those overtime, bonus, commissions, etc., over the last 2 to 3 years, then you can get the majority of those taken into account when the lender is deciding the multiple of income that you can afford to borrow. So if you have been earning overtime, bonus, commission consistently over the last 2 years, for example, then you should be able to add that to your salary and multiply it by 4 to determine the amount you can borrow. However, with variable pay, if you've just recently started a job and you're now earning commission, but maybe you've only been earning it for 2 to 3 months, and you didn't earn that in your previous job, then they're probably not going to give you the full benefit of that variable pay when deciding what you can borrow. So yeah, moral of the story is with variable pay, you need a history of it before the banks will take it into account. So likewise with self-employed people, when you're self-employed, they will also look at your income over the last 2 or 3 years. As a self-employed person, you need to do a tax return once a year, and the bank will look at what your taxable income is over the last 2 to 3 years, and they'll generally take an average of your last 2 or 3 years' income. So when you're self-employed, it's a little bit more complicated than when you're just on a basic salary. They will look at your business, how that's doing, how your business bank accounts are doing, and can your business afford to pay you what you've been paying yourself over the last 2 or 3 years. So it is important to seek advice if you're self-employed to determine the amount you can borrow, and we are of course here to help you with that. So things like your age and the amount of children you have can also determine or restrict the amount you can borrow. So if you are if you don't qualify for the maximum mortgage term of 35 years, for example, if you're in your 40s or 50s and only qualify for a shorter mortgage term, then yeah, the amount you qualify for may be restricted. Likewise, if you have children, then they are seen as an outgoing by the bank, so they can also restrict the amount you can borrow. Loans and other outgoings can also restrict the amount you can borrow. So if you have big loans and big repayments on those loans, then yeah, that can restrict the amount you can borrow. So in the 6 months before you apply, it's best to get your debts reduced as much as possible. So if you can pay down any big loans you have in the 6 to 12 months before you apply for a mortgage, that will help when it comes to determining what you can borrow. The good news is there are exceptions. So if the 4 times your income is not enough and you need more, it is possible to get an exception over and above the 4 times your income. So exceptions can be hard to get. So it is important to make sure you have a really good application if you need an exception. But again, ask your mortgage broker or ask us and we'll explain fully how exceptions work and if you qualify for one. So now I'm going to move on to talk about the Help to Buy scheme. So the Help to Buy scheme, it's been around for a few years now, and it basically is a rebate of tax you have paid over the last 4 years. And basically you can get up to 30,000 as a tax rebate towards the cost of your new home. There are qualifying conditions, which are as follows. So you must be buying a brand new home or self-building your own home. You must, after you buy the home, live in the home for up to 5 years. If not, there's a chance that revenue could try and claw back some of that 30,000 from you. The the mortgage amount you're borrowing must be at least 70% of the property value as well. So yeah, you do have to borrow at least 70% on the mortgage. The value of the property you're buying must be 500,000 or less. So there is a restriction on the value of the home that you can be buying. It has to be 500,000 or less. And the maximum amount you qualify for under the Help to Buy scheme can be the lesser of 30,000 or 10% of the purchase price or the tax you have paid in the last 4 years. So it's the lesser amount of those three. So if you've been paying tax for 4 years, chances are you've paid over 30,000 in tax, so you will qualify for the full amount. But if you're buying a property for less than 300,000, then the 10% may be less than 30,000, so you may be restricted by the 10% of the purchase price. But in general, most people should be able to borrow the full 30,000 towards the cost of your new home. So next, I'm going to talk about the First Home Equity Scheme. So the First Home Equity Scheme was introduced in 2022, and it is designed to help first-time buyers bridge the affordability gap. So what does that mean? So basically, if you are looking to buy a new home and the mortgage amount you qualify for and your own savings, you don't quite have enough to buy the new home you need, then there is a chance to get the First Home Equity, to avail of the First Home Equity Scheme, and it will help you bridge that affordability gap. So it is what's called a shared home equity scheme. So effectively means that if you are using the scheme, the government is taking a share in your property value, in your property in return for a share in that property. So yeah, they're taking an equity stake in your home in return for helping you buy that home. So again, with the First Home Equity Scheme, there are qualifying conditions. You must be a first-time buyer, and you must be over 18, and you must be buying a brand new home. So also, you must secure mortgage approval from a participating mortgage lender. And the mortgage lenders participating in the scheme are all the main Irish lenders. So you're looking at the likes of AIB, Bank of Ireland, Permanent TSB, Haven Mortgages, etc. Some of the foreign banks that are lending in Ireland, like Avant Money, Finance Ireland, ICS Mortgages, you can't avail of the First Home Equity Scheme with them. It is just the main Irish banks. And you must be borrowing a maximum amount within the central bank lending rules. So you must be borrowing the maximum amount you qualify for in terms of a mortgage, and then the First Home Equity Scheme can help you bridge the remaining balance that you need to buy the new home. The First Home Equity Scheme then must also be taking a minimum equity share in your property of 2.5% of the property value, or 10,000, whichever is less. So that's the minimum stake that the First Home Equity Scheme will want to take in the property if you're availing of the scheme. The maximum funding available to you from the First Home Equity Scheme is 30% of the property purchase price, or it's restricted to 20% of the purchase price if you're also availing of the Help to Buy scheme. And we'll talk about that a bit further now in a sec. There are county-specific, property price ceilings. So you can check those on the First Home Scheme website. In Dublin, just as an example, the maximum house price you can buy is 475,000 with the First Home Equity Scheme, or 500,000 for an apartment in Dublin. In Cavan, you can be buying a home for a maximum purchase price of 325,000, or an apartment for the same value if you're buying in Cavan. So that just gives you a flavour of the property prices that you're restricted to. So there is a cap on the amount you can be buying a new home for. If the home is more than the cap, then you just won't be able to avail of the First Home Equity Scheme. One thing to note about the First Home Equity Scheme as well, just to kind of summarise, is if you are availing of the First Home Equity Scheme, it is important to realise that the government is taking an equity share in your property. If you're getting 20% towards the purchase of your home, then they're taking a 20% 20% stake in your home. So at some point in the future, you'll have to buy out that 20% share. So the good news is with the first home equity scheme, you don't have to pay any money back on that 20% share that they have in your property for the first 5 years. After the first 5 years, there is a charge after that, and that goes up as you get into it. So you will have to buy out the first home equity scheme at some point in the future, and yeah, you'll get a chance to do that. So you won't be under pressure to buy them out, but if the property is ever sold, or if you want to at some point in the future, yeah, you can, and you do have the option to buy them out. Just on that, before we move on, it is in your interest to try and buy out the first home equity scheme share as soon as you can, because they do have a percentage share in the value of your home. So in 5 or 10 years, they will still have that 20% share. So that as your property increases in value, the 20% equity stake that the government has in your home will also increase in value. So the longer you leave it to buy them out, the more you will have to pay. So it is in your interest to try and get it paid back as soon as you can. So it bridges the affordability gap when you're buying the house. But yeah, it is important to try and buy it out whenever you can afford to do so. So also just to note, the first home equity scheme is also available to self-builders. So if you're building your own home, you can also, and you're a first-time buyer, you can also avail of the first home equity scheme. Also, if you're a tenant purchaser, you can also avail of the first home equity scheme. This is the only instance where you can avail of the scheme where you're not buying a brand new property. So if you're currently renting from your landlord and your landlord gives you a termination notice, then you have the first option to buy that property from the landlord if you can afford to do so. And if you can't afford to do so, then you can avail of the first home equity scheme to help you bridge the affordability gap. Yeah, so as I say, that is the only instance where you can avail of the first home equity scheme when you're buying a second-hand property. So it is possible to use the first home equity scheme and the Help to Buy scheme together. And in the following slides, I've done up some examples of how you can use the Help to Buy scheme and first home equity scheme together. I've got two specific examples using a property price of $350,000 and also a property price of $450,000. So the first example here, if you're buying a new home for $350,000 and you're availing of the first home scheme and the Help to Buy scheme, the purchase price is $350,000. So your total outlay is going to be $350,000 plus your stamp duty of 1%, which is $3,500. You will have your solicitor's fees of $2,500, giving you a total outlay of total funds that you need of $356,000. So that can be funded as follows. So you can get a mortgage of $250,000. In this example, the mortgage is $250,000. You can get $30,000 from the Help to Buy scheme. You can get $70,000 or a 20% of the property purchase price from the first home equity scheme, giving you total funding of $350,000. So in this example, there's a shortfall of $6,000 that you need to cover from your own savings towards your solicitor's fees and stamp duty. And to qualify for the mortgage of $250,000, you would need a joint or single or joint gross annual income of $62,500. And also, it is important to note that if you're availing of the first home equity scheme, you cannot borrow more than 4 times your income. So you can't avail of an exception for more than 4 times your income if you're availing of the first home equity scheme. So in the second example then, if you're buying a property for $450,000 and using the Help to Buy scheme and the first home equity scheme, then in this example, the purchase price is $450,000, your stamp duty is $4,500, your solicitor's fees are approximately $2,500, and the total outlay there is $457,000. So the mortgage amount you would qualify for, or in this example that you would be getting, is $330,000. You could get 30,000 from the Help to Buy scheme, and you could get 90,000 from the First Home Equity scheme. So that would be total funding of 450,000. So again, you would need to cover the shortfall of 7,000 for your solicitor's fees and stamp duty, and for the mortgage of 330,000 towards this purchase price of 450, you would need a single or joint gross annual income of 82,500. And again, just to mention, you cannot avail of an exception, so the maximum amount you can borrow is 4 times your income. So hopefully those couple of examples just give you an idea of what is possible with the when you use the Help to Buy scheme and First Home Equity scheme together. But yeah, just note you do have to be buying a new home. So moving on, mortgage advice, what are your options? So when it comes to applying for a mortgage, what are your options? So your main 2 options when applying for a mortgage is you can obviously use a mortgage broker like ourselves, or you can go to a bank directly. So listen guys, I'm obviously a mortgage broker, so I'm 100% biased in this, but I do feel it is really beneficial to use a mortgage broker. There's so many benefits, and I'll show you what those are now. So when you apply through a mortgage broker, you save yourself time. So instead of checking several banks to see what you qualify for, a mortgage broker will look at all of the different options, and they'll see what the best option is for you in terms of loan amount and in terms of the best interest rate that you can get. And bear in mind that a mortgage broker works for you, so they want to get you the best and make sure you're happy. So we'll save you time. Experience. So mortgage brokers like ourselves are very experienced. We've been doing this for a long time, and we can help you every step of the way. What does that mean, every step of the way? Well, basically it means that we'll be with you right the way throughout the process. And buying a home can be a long process, so it can take anywhere from 3, 6, 12 months really. So if you're going to be spending 6 to 12 months getting a mortgage, buying a home, you want someone on your side that you know and can trust and you have on side when you need them. So as your mortgage broker, yeah, we'll be there every step of the way during the whole process. Research. So as your mortgage broker, we will research the market for you, and the mortgage market is constantly changing in terms of mortgage interest rates, the loans amount you qualify for. Banks are kind of tweaking their criteria every now and again. There's new mortgage lenders coming into the market from time to time. There's cashback and other incentives, home buyer schemes. So we have the expertise to help guide you through all these different things. So yeah, we're here to help you. So let us guide you. And another advantage is with a mortgage broker like ourselves, you make one application and all mortgage lenders are covered. So we're not just applying to one particular bank. We're making sure we look at all of your options, talking them through with you, and making sure you get the best option for you. A mortgage broker will also help you with things like mortgage protection and home insurance. So with MortgageLine, we deal with all the different life insurance providers, and we have agencies with home insurance companies as well. So we can make sure you get the best deal on those products. And with the professionals that you will need, you'll need a solicitor, for example. You may need a structural surveyor. If you're buying a new property, you might need someone to do a snag list for you. So we have panels of all these professionals, and we can help guide you in the right direction and make sure you get someone that you can trust and that we've used before, and we know they do a good job. Okay, guys, so I hope that was beneficial and you got some information out of that. And I hope I didn't come across as being too nervous. It is my first time doing a webinar like this, so I hope you're able to understand what I was saying and explain myself well. So now, guys, we're going to cover off some questions and answers, and my colleague Joanna is going to come in now, and she's going to pose the first question to Kevin.
Thank you, Stephen. So let's look at the questions. Kevin, And the first question is, if I have a stamp 1, am I eligible for a mortgage?
Short answer is yes. More complicated answer is it depends on the stamp. Stamp 1 isn't specific enough. So you have different types of stamp 1s. You have stamp 1 critical skills or stamp 1G, which is taken by pretty much all the banks. You have stamp 1 general employment, which a lot of banks don't look at. And then you have stamp 1's A or H, and yeah, pretty much no bank is going to take those into account. So it depends on the specific stamp 1 that you have. And all lenders would take stamp 4 or 5 or 6, which is, pretty much the equivalent of an Irish passport.
Brilliant, thank you. The next question is for Stephen. We are not originally from Ireland. Can we apply for a mortgage?
Yeah, so that's a good question. And following on from what Kevin said there about the stamps, so if you're not originally from Ireland, you can absolutely get a mortgage. But most mortgage lenders will want you to be living in the country for at least a year, and they'll want you to be permanent in your job and past any probation period. They will also have a few extra requirements if you've just recently come to the country. So they will want you to get a credit check for whatever country you were previously living in. And if you have any active bank accounts or anything financially going on in that country you were previously living in, they will want to know about those things. So yeah, you might have to provide a few extra bits and bobs, but in general, yeah, just because you're not from Ireland, if you're living and working here, you should be able to get a mortgage here.
Brilliant, thank you. The next question is for Kevin. Kevin's question about solicitors. At what point should I contact a solicitor and how to choose one?
It's never really too early to start getting in touch with solicitors, but really up to the point of you being sale agreed on a property, there's not really much that they can do. So yeah, absolutely shop around before you go sale agreed on a house. But when you go sale agreed on a house, that's when the solicitor can actually start working on the case. So you kind of have, the ability to change your decision anytime up to that point. And then in terms of how to choose one, I just tell people, you want somebody who deals in conveyancing regularly. Law is such a vast area that you could have a brilliant family law or criminal law solicitor who doesn't deal with mortgages. So you want somebody who just deals with mortgages day in, day out, and you won't go too far wrong if you do that.
Thank you. Stephen, mortgages for a new and old home, which is the best?
Yeah, so there's no straight answer to that, I'm afraid. It's if you're buying a new home, there's obviously advantages of buying a new home. It's probably going to be a very good energy rating. So your BER will probably be an A if it's a new home built in the last few years. So with a good BER energy rating, you will benefit from a discounted mortgage rate from most banks. You can get what are called green rates, which are discounted rates off a bank's normal rate. So you can pay a bit less with a new home. There are obviously other advantages of buying a new home. Like I've just went through, you can avail of the Help to Buy scheme and the First Home Equity scheme. So that's an advantage if you've got an affordability gap, or you just want to get a tax rebate from the government. And listen, who doesn't want to get a tax rebate? If you're buying a second-hand home, there are advantages there as well. That there just may, in a lot of circumstances, there may just not be any new properties in the place you're looking to buy. So in that case, you may be restricted to a second-hand home. Disadvantages of a second-hand home, yeah, it's not a new home, so you may have a bit of work to do to it to make it your own. So the good news is with second-hand homes, they're generally priced a bit keener than new properties of a similar size. So although you might have to put a bit of money into it, you probably will get it for a bit cheaper than you would a brand new home. Yeah, hopefully that answers that question.
Brilliant, thank you. Kevin, question for you. It's regarding application. How long does approval takes once you submit everything?
So there's a couple of different types of approval in principle. There's a soft approval in principle, which is generated pretty much instantly. They don't really check any documents to do that, and a lot of lenders will issue that soft approval to kind of give you a push to go and go sale agreed before they actually start using resources to assess you. For a formal approval, which is where you do submit all your documents and it is looked by somebody within the bank, and an underwriter does make a credit decision on it. It really depends on the lender. There's some that are as fast as a week and some that are as slow as 8 weeks. It just depends who to the time of year you're going to them, how busy they are at that time.
Brilliant, thank you very much. And Stephen, you covered some of the schemes. So there's a question regarding a first-time buyer scheme. Are we eligible a max amount of 30,000 per applicant, so 60,000 in total?
Unfortunately not. It'd be great if you were, but no. If you're using the Help to Buy scheme, the maximum amount you can get towards a property is 30,000. So that it doesn't matter if you're one applicant or two applicants. The maximum amount, I'm afraid, is 30,000. Yeah. So the only way to get 60,000 towards a property is if you were buying two properties. So if you're a couple, you could each buy a property and get 30,000 each towards the value of the property. But if you're buying jointly, the maximum amount you can get is 30,000 towards that particular property.
Thank you. Kevin, best mortgage duration?
Short as you can afford, simple answer. I mean, if you take a typical mortgage of, let's say, 350k, the difference between 35 years or 30 years would be over 60,000 in interest. So obviously you're better off going to 30 years, but that also would increase your monthly repayments by over €100. So, I mean, if you can afford the extra €100, yeah, go to 5 years shorter. If you can't afford it, then don't. There is also an extra thing called overpayments as well, which is where a lender will allow you to pay extra during your mortgage, during a fixed rate. And if you have that, it kind of relieves the pressure on the mortgage term, because even if you did set out a 30-year term and you didn't want to pay the interest on a 30-year term, well, you can just make overpayments throughout the year or throughout the years and kind of naturally bring that 30 years down, because it would take off the payments at the end of the mortgage. So by making a 20 grand overpayment, you might go from 30 years to 27.5 years, for example.
Thank you. The next question we have for Stephen is regarding the self-employed person. Is it harder to get a mortgage as a self-employed?
Yeah, so I touched on this a small bit in the presentation. It is a little bit more tricky because if you're self-employed, there's a bit more going on in terms of your income. So you can be a sole trader, you can be on a contract, you can have a limited company, and so you can have multiple streams of income as a self-employed person. So there is a lot more going on. But in general, a bank will look at what you've earned over the last 2 to 3 years. So what it says in your tax returns over the last 2 or 3 years, and they'll look at an average of those, and that's what's used when determining the amount you can borrow. But yeah, with especially if you have a limited company, one advantage might be that you may be paying yourself, just as an example, a salary of 50,000 from your company. But when a bank looks at your accounts, they may be able to see that you actually could have afforded to actually have paid yourself a higher salary of 100,000. So they'll give you the benefit of a higher salary, even if you didn't pay that to yourself. So there are ways that kind of maximize the amount you can borrow if you're self-employed. So it is important to seek advice. Ask us. We're self-employed experts. We deal with self-employed people every day, and we know exactly how it works with the banks. So yeah, if you're self-employed, seek advice from a mortgage broker, and they'll guide you in the right direction and make sure you get the max amount you qualify for.
Thank you. Kevin, the next question is, do banks go easier when applying for lesser amount?
Not that they go easier, but it's an easier decision. It's a quicker decision. So in a way, yes, like if you're nowhere close to your limits, it's much easier for an underwriter to say yes to that decision. But if you're maxed out on every metric that they're measuring you on, the underwriter really has to think about if you can afford it, and if it's responsible to allow you to afford it, is even because you might be arguably over the limits on some metrics depending on their judgment. So yeah, it definitely makes it a quicker and easier process, but it's just because the decision is more obvious.
Thank you. And Stephen, any tips for selling and buying the new home at the same time?
Yeah, so it's not a first-time buyer question. This is a first-time buyer webinar, but listen, we're open to anyone who's looking to get a mortgage and give them advice. So Yeah, it's a good question and something that comes up quite a lot. If you are looking to move home, you're looking to sell your own home and buy a new home, there are a few things you can do to make that a bit easier for yourself. So first of all, get a good solicitor. And a good solicitor is really invaluable if you're buying and selling a home at the same time. Your solicitor will coordinate the sale of your own home and the purchase of your new home and make sure they close as close to possible, as close to each other as possible. And one thing you can also do is, if you're buying a home and selling your own home, then you can try and use the same estate agent for both transactions. Then they'll have skin in the game for the sale of your house, for the house you're purchasing as well, and they will, and the estate agent will do the best for you if they're involved in both transactions. So yeah, if you're selling a home and buying a home, you're effectively in what you would call a chain. So some estate agents don't like that. Some estate agents prefer to deal with first-time buyers if they're looking for a quick sale. So it can be a disadvantage if you're selling a home and buying a home, because you're effectively in a chain. So one thing you can do in that situation as a person selling a home is try and sell your home to a first-time buyer. It'll just make things a bit easier for yourself. But yeah, buying and selling can be tricky, but it is possible. So just get a good solicitor, and if possible, use the same estate agent for both transactions. Yeah. So I think, guys, we've maybe got time for one more question, Joanna.
Yeah,
do you have another question?
That's actually for Kevin. I pay my rent in cash. Can I apply for a mortgage?
Yeah, absolutely. When you're paying in cash, you just have to try and make it as clean and obvious as possible. So if your rent is €1,000 per month, take out €1,000 from the ATM a month. Don't take out, three 300s or two 500s. It's not as straightforward looking. And then also make sure that you have a copy of your tenancy agreement with your landlord to say that your rent is €1,000 a month. And yeah, once you make it clear and obvious every month, and it's taken out kind of the same time every month in one lump sum transaction, and you have a tenancy to kind of back that up, you should be fine. Yeah.
Thank you.
No problem.
Okay, guys. So thanks, Kevin and Joanna, for helping out with the questions there. So listen, guys, I hope everyone's got value from this webinar today. If you have any further questions, we'd love to hear from you. Obviously, get in touch. You can get us through our website there, mortgageline.ie, and we'd be really glad to hear from you and help you out in your mortgage journey. So thanks a million to everyone who joined. We're really delighted with the amount of people that joined. We hope you got value out of this webinar. The recording will be on its way to everyone in the next day or two. So listen, happy Christmas, everyone. And thanks a million for joining. We'll see you again soon.
Take care.